Welcome back to Trendlines over Headlines, the show where we break down the markets with some of the best traders and analysts out there. My name is Patrick Dunawilla. I'm the editor of the Chart Report, and I'll be your host. Joining me today is David Settle. David is the founder of Market Scholars, an investor education platform where he teaches people how to navigate the markets and manage risk. He's a fantastic technician, so I'm really excited to hear his take on the markets. But before we talk to David, it's Friday, the markets are closed, so let's take a quick look at how this week played out. Hey guys, thanks for watching. Just a quick reminder, be sure to click like and subscribe so we can continue bringing you awesome content. Thanks. All right, so it was a choppy week, but all four major indices closed higher. The NASDAQ led, gaining nearly 6%. The Russell 2000 lagged, but still rose about 3.5% on the week. Taking a quick look at the S&P 500, we finally got a positive Friday. The past 5 Fridays have all been down, but here we are ending the week on a strong note for once. We're continuing to hold above the 200-week moving average, and we're above the June lows, so fairly constructive, but there's a lot of damage to repair, so we'll see if the bulls can build on this success next week. Now, taking a quick look at the sector performance, energy continues to be the best house on the block, gaining more than 8% this week. In terms of laggards, defensive sectors like utilities and consumer staples lagged, but they still rose about 2% on the week. Anyways, that's enough from me. Let's see what David has to say about this market. All right, David, welcome to the show, and thank you so much for joining us.
Well, thank you for having me. I appreciate being on with you.
Yeah, of course. So we have a ton of charts to get to, but before we get to the market stuff, could you just give us a little bit more background about yourself and tell us a little bit more about what you're currently doing at Market Scholars?
Sure. I've worked with TD Ameritrade / Thinkorswim / Invest Tools, which is an investor education outfit for pretty much since about 2004, I think is when I started. So going on, 15 years or so, I worked with them, and my job description was basically just teaching people how to trade stocks, how to invest, and different options, stocks, all different sorts of things, technical analysis, fundamental analysis, and so it got to a point where a partner and I decided to leave and start our own investor education outfit, and that's where we started about 5 years ago. We started Market Scholars, and we kind of do the same thing. We teach classes online. People subscribe to our site. We teach classes online, and they basically look over our shoulder as we kind of look at the markets and talk about how to trade them with different strategies as well as invest kind of long-term strategies as well. So same thing, but just the two of us now instead of a big corporate company behind us. Very
cool. Yeah, I mean, I'm very familiar with Thinkorswim. It was my first charting platform. And so basically you guys are doing market education, like for traders and investors?
Yep.
Yeah, because I know your partner does a lot of like the long-term dividend stuff, and you do more of the technicals and kind of trading aspect. Is that correct?
That's exactly correct. Yeah, I do kind of more active trading, and he's more of the investor. Especially, he is probably one of the top experts in dividend growth investing, which is kind of a popular topic, popular niche in the market, especially among long-term investors.
Well, anyway, let's get right into it. We're recording this on a Thursday as usual after market close. So the week isn't quite over yet, but so far, not terrible.
We'll see tomorrow. Like we've had how many Fridays? We've had like, I don't know how many Fridays in a row we've had a decline. And every one of them has been at least 1%, if not 2%. So I think I saw the last 2 months, we've only had one day on Friday where we rallied.
Yeah, no, the S&P has had a case of Freaky Fridays for sure. So as you said, we'll see how we close the week tomorrow, but not terrible. I mean, we're up 2% on the week. A lot of that strength has kind of faded. We were up more earlier. So it's not that kind of energetic bounce that you'd want to see off the lows just yet, But I want to ask you, what do you make of this little bounce, and has it materially changed your view at all? Because you've been pretty cautious on the market lately, is that right?
Right. Yeah. I think most of the gains this week so far actually occurred before the market even opened on Monday. And so everything we actually gained from Monday's open, we've almost lost it all. And so we're kind of at that point where if we do get one of those Freaky Fridays tomorrow and we start to fill in that opening gap on Monday, then we will have lost it all. And we'll maintain that kind of bearish stance. Obviously we're in a bearish trend. So we'll maintain that bearish stance until something changes. But if we rally and we get closer tomorrow or even early next week, if we get closer to this really important 3,800 level, I think there's multiple Fibonacci lines that are sitting like right on top of each other across multiple time frames. So when you look at like the year-to-date decline, when you look at the current intermediate decline we're on right now, when you look at like long-term rallies, you have multiple levels sitting right at 3,800. So if we get through that, then the trend can change, at least in the intermediate term. But assuming resistance holds until it doesn't, that's what's a common thing that we talk about market scholars, then yeah, I don't expect it will, and I think we'll probably, if we follow the trend and we close lower tomorrow, we fill in that gap on Monday, then we're very less likely to break above that 3,800 level.
Yeah, and talk about a key level. I mean, we got the 200-week moving average. We've been kind of holding it these past like 2 weeks, but we're still testing it. And man, it really looks like it's skating on thin ice. But I want to get your perspective on bear markets, right? We all joke about the media's definition of a bear market, right? 20% decline from the highs. I mean, 20% is just such an arbitrary number. And we've seen scenarios where we've gotten like a 19.9 or 19.8% decline. And what are we not going to call that, a bear market? Right. It's arbitrary. I get it. We need some sort of criteria to define these things. But one thing I love asking technicians is, how do you define a bear market? Because I get all sorts of answers. Everyone has their own way of defining it, right? Some people use, new highs and new lows. Others use trend-based things. Others use a combination of price and time. So my question for you is that, how do you define a bear market?
So what you've got on the screen, this 200-week moving average, that's a really important thing. If you notice, when we are in bear markets, we will get below that 200-week moving average and stay there. Generally stay there long enough that the 50-week moving average will cross down along with it. Like, for example, COVID, we got below it for a couple weeks and then jumped right back above it. I mean, that was probably the deepest, fastest correction that the market has had outside of maybe 1987, where it was pretty much like a 2-week drop. But it got down below the 200-week moving average, popped immediately back up. That's not a bear market, right? I mean, that's the 200-week moving average didn't even change direction. It just kept going up. But when you get below it, when you're below it long enough that 50 crosses below it too, now we're talking. Because if you look back at 2000, the last ones we've had, 2008, 2001, to 2002. Like, once we broke the 200-week moving average, we dropped from that point 35 to 45% from the 200-week moving average. Everybody talks about, obviously how much we dropped from the high, but we were 45% above the 200-week moving average at the beginning of the year. So a 20% drop from that high is not going to it's going to barely scratch the surface and correcting what was like an insanely bullish market at the beginning of the year. So, real bear markets, they'll get below that 200-week moving average and then just trend below it for a year. I've seen about 6 months when you look at the 81, 82, because it didn't stay there but for too long there. I've seen up to 18 months, which was the 2001 to 2003, you were 18 months below the 200-week moving average.
Yeah, because I've seen you talking about it on Twitter, and you're still referring to this as a correction at this point. I'm saying, what? I mean, we're down, over 25%, or we were. So your definition is really, are we above or below that 200-week moving average, right?
Yes, yeah, because again, it's kind of like what you're saying before, the 20% arbitrary number. We can use that as long as every peak we come down from is always the same, but not every peak we come down from. I mean, this, again, I refer to like we were 45% above the 200-week moving average
Coming into the year?
at this peak. The S&P was.
Okay, wow.
So that's a high level. In fact, it's the third highest level that it's ever been, ever. So like you obviously had the late 90s, and that's why you had a 3-year bear market to correct, to wash that out. The other time that we were that high was 1987. That was, famously Black Monday that corrected that. So like, and that wasn't even a bear market. That all that did was get you back to the 200-week moving average. And so we've had a big drop this year, seemingly a bear market, simply because we were so insanely bullish at the beginning of the year, way too bullish.
Yeah, and you have this other great chart here, kind of saying something similar. Basically you're pointing out that that indicator in the lower panel is the 12-month rate of change. So basically the year-over-year percentage change in the S&P 500, right? And you pointed out that coming into this year, we were the highest we've ever been in terms of that 12-month percentage change. So, if we're using the rubber band analogy, you're saying the rubber band was very, very stretched, extremely stretched, the most stretched it's ever been to the upside. And so this reaction that we're seeing, reminds me of that Bob Farrell quote, excess in one direction will lead to an excess in the opposite direction. So is that what you're looking for here?
Yeah, exactly. I mean, you see the other two instances I marked. One of them is coming off of the 2008 low point, that bear market low point. We were so excessively bearish on a 12-month basis that we rebounded up 50% on a 12-month basis, right? Again, 12-month closing basis, right? Monthly close. And outside of that, you have to go all the way back over there to the early 80s that we had another 50%. So this peak at the beginning of the year at 53%, 12-month basis, is the highest since the S&P became a 500 stock index. And you would think, oh, it's because we were stretched and the downside, and we just rebounded to the upside. We stretched in the other direction. But the COVID bottom, which I highlighted there in blue, was actually only an 8% decline on a 12-month basis. I mean, that's a drop. But it's not, I mean, you can obviously see the bear markets on this chart, right? You can see the 08, how deep it got. You can see the 2000 to 2002. You can go back to the 80s. You can go back to 1973, 74. And you look at where we're at in COVID, and you look at where we're at now, and you think, well, is this a bear market compared to those other 12-month declines? You can see we're just not quite there yet.
Yeah, and, a lot of people have tried to compare this market to a lot of different other environments. You see it compared to 2008, and it's actually been kind of following that analog pretty well. But I think it's a little intellectually lazy to just say, oh, it's '08 again. It's not. This is a different scenario. But that being said, I think there is value in looking at other periods and kind of the similarities and how price responded in these different environments. And one analog that you've been bringing up a lot is the 1973 and 74 period. And I think it's a really interesting one. I mean, you basically, the S&P 500 peaked around January of that year, I think, and then fell 16%. Then it broke the 200-week moving average, your definition of a bear market. And once it did that, it was already down 16%. It then fell another 30, 40%. So walk us through this one and tell us what the similarities are between this current market environment and 73, 74 from your perspective.
Yeah, so unlike the last one, which, like you said, a lot of people lazily kind of compare this to, we stopped raising interest rates in 2006. The market peaked more than a year later. in October of '07. And of course, the bear market really kicked in gear in '08. Same thing with 2000, right? They stopped raising rates. The market peaked later, like a year later. In 1973, 74, inflation also took off. And the Fed started raising rates just like they are now, not as fast because they weren't as low, but they started raising rates. And you can see how we dropped, like you said, we dropped to that 200-week moving average. We bounced off of it, got to right around the 30, 50-week moving average, just like we did this go around, held that for resistance, and then broke through the 200-week, like I believe we're in the process of doing right now. If we were to make our way down to 3,200 on this current this return, a lot of times in technical analysis, when you break a support level like a moving average like that, you can see at the end of 73, beginning of 74, you had a little bit of a rally back up to it. That's called a return move, where you break a resistance, break a support, you come back to it before you get going on the breakout. So it made a return move back up to it at the beginning of 74, and then, like you said, dropped. Like that's when the bear market kicked in gear. Is there in 74. The Fed didn't stop raising interest rates till July of 74. That's very similar to what we're seeing right now. Like they're not expecting it to stop raising rates just because we're at the 200-week moving average. Like they most likely, if we continue on this path, this trend, and do actually break it, they're not going to stop raising rates until we're below the 200-week moving average. And that's, again, very uncommon because 2008, that didn't happen. They stopped raising rates well before the peak. 2000, they stopped raising rates before the peak. Just like in 74, they didn't start raising rates till well after the peak, just like this year. And then they won't stop until we're below that 200-week moving average. So this, from a Fed policy inflationary standpoint, this is probably the best analog for what kind of bear market we might be headed towards.
Yeah, and to bring it back to our earlier conversation about, using the 200-week to define bear markets, that 16% initial drop to the 200-week, that seemed, insignificant compared to the 30-40% drop that followed. So to your point, the bear market, that in total, that was pretty much a 50% decline. But to your point, the bear market didn't really get going until we broke that 200-week moving average, and here we are today testing that 200-week moving average. So
same thing with 2008, we dropped 20% down to it to get to it, and then but ultimately, like you said, was more than a 50% decline when it was all said and done.
Yeah. So I want to move on to small caps here. The Russell 2000s held up relatively well. It was the only major index that didn't make a new low. Dow, S&P, NASDAQ, they all broke their June lows. And I think that's pretty notable, right? The Russell 2000 hasn't seen a new low in 4 months since June? That's all the doom and gloom out there. And, one of the most risk-on major indexes hasn't made a new low in 4 months. That's something. So what do you think? Should bulls be encouraged by this, outperformance from small caps? Because small cap outperformance is generally perceived as bullish, right?
Right. Theoretically, again, we're talking like we don't get very many like real bear markets, so we don't really know. At least we don't have a whole lot of recent experience about how small caps outperform perform when we're in a bear, like a real bear, again, below that long-term moving average. So if you look at this chart here, small cap stocks, actually, this is the ratio chart of the Qs. So the largest of large cap, stocks, and then the IWM, right? The Russell 2000. So if you notice here, the ratio peaked with COVID, right? The Qs is technology stocks and the ARK investment, innovation type stocks, right? They took off. And then you see there's a little bit of a drop in early 2001. That drop right there was when the reopening trade, the vaccine came out, the reopen trade was popular, everybody's going to travel again, the world's going to get back to normal. And the Russell 2000 skyrocketed. And that's actually when the Russell 2000 peaked. So the S&P peaked earlier this year in January. The Russell 2000 peaked, like the main peak was in March of 2021. So the reason why the Russell 2000 is not dropping to new lows right now is not because money is shifting to small caps in anticipation of a bull market. It's because the Russell 2000 has already been in a lot bigger of a correction than the Qs have been. They've been declining for a lot longer. They're actually already below their 200-week moving average. The Russell 2000 is, and so when this ratio drops, you saw that little blip there in 2021. Again, vaccine, presidential election, that prompted a lot of positive sentiment, right? That really pushed that reopening trade all the way into
small
March.
caps took off after the election, and they actually kind of have a habit of doing that. If you look back at the elections and the action that follows from small caps, for some reason, small caps love when that uncertainty from the elections are gone. They just tend to, the last three elections they've just ripped after.
Skyrocket.
Anyway,
and then you add on that vaccine, which came out like the next weekend. Like, in fact, it was like the same weekend that the election results were certified, I believe in Georgia or something. The vaccine news came out too, the same weekend. So we gapped up on Monday and just took off from there.
That's right.
But if you look over to the left on the 2000, 2001, this period in the market's very similar to that period in that there's huge disparities in sector weightings towards technology. Back then, it was just technology. Now it's broken out, right, into the consumer discretionary and communication services because they made the sector changes. So now you have these huge disparities in weightings leaning towards that technology area or the QQQ that was very similar to 1999, 2000. And that ratio, so small caps outperformed throughout the bear market as the Qs underperformed, and that sector disparity, though the disparity in those weightings started to come back in, right? Technology from 1999, technology lagged behind for a long time because they had so much, to give back in terms of valuation. And that's what's going on now. Like right now, if this ratio drops, which assumes that small caps outperforms, it won't drop during a bull market, right? The beginnings of a bull market, because that's not what this does. It will drop because of those sector disparities are still there. We're still heavily weighted towards technology. So if this ratio drops, it's actually going to drop like it did in 2000, 2002 during a bear market, right? When all those large cap tech names start giving back some of those high valuations.
Yeah, so you're basically saying small caps could continue outperforming on a relative basis, but on an absolute basis, still decline, right?
Yeah.
And it's funny, this chart reminds me a lot of the growth versus value ratio chart, and it's kind of saying something similar, but yeah, not exactly, but something similar. Anyways, I want to move on to commodities real quick. Been the only asset class to hide out in this year, the only positive asset class. It's still up like 20% on the year to date, but it hasn't really gone anywhere since June. It's been kind of this choppy mess. Here we are below the 200-day moving average. So what do you think of commodities here? Do you think they'll work lower from here? And if so, what does that mean for stocks and other asset classes?
So I know you're a CMT like I am. So you've read that, John Murphy book, Intermarket. I don't even know the name of it now. It's like Intermarket Relationships. But the famous concept that he's taught is that bonds lead stocks lead commodities. Bonds, stocks, you also throw in currencies, right? Currencies, bonds, stocks, commodities. The dollar had its bear market. Bonds had their bear market. We're in their bear market right now. Stocks has had their correction. Commodities, which is the lagging asset class, still has not had that correction yet. Remember, stocks are correcting. We filled in the gap between the 50 and 200-week moving average. Bonds are way below the 200-week moving average right now. So they're in bear market. The dollar's already done that. And the dollar's actually rallied, took off like a rocket, right? So the commodities are the last shoe to fall. In a bear market, commodities start to correct in a bear market. I mean, that's what they do. That they're the last thing. They inflation rears its ugly head at the end of very mature bull market secular cycles. The Fed raises rates, commodity prices go up because of that's inflation. They start raising rates to curb inflation, which puts pressure on commodities. Imagine if the dollar was actually not parabolically high right now, where commodity prices would be. Right?
Yeah.
I guess if you're in Europe or Japan, I guess you're understanding the scope of how high commodity prices are right now. We haven't had that because thankfully the dollar's been so bullish, but at some point in time, the commodities will start to correct, because they always do. They will correct from a lack of demand, right? And that lack of demand is a deflationary, recessionary, bear market type concept. So, and they always start to correct inside of that. And they will also break that 200-week moving average. They do it last. Stocks haven't done it yet. If we are going into bear market, stocks haven't done it yet. Commodities will do it last. So yeah, I believe that the commodities will benefit from a drop in the dollar, which is ironic because we all want commodities to fall so inflation falls. But I believe that the dollar will start to pull back. That will be short-term benefit to commodity prices, but eventually that demand destruction, which is what the Fed's looking for, will break commodity prices below that 50, start that correction, and then that's when that's the last shoe to fall that we're in a bear market at that point.
Yeah, so basically if that John Murphy framework holds, commodities probably going to be the next, or the last shoe to drop, as you said. So let's move on to rates. I think that's a great segue. 10-year, I mean, now solidly above 4%. It's just relentless. And I mean, that's the highest level since 2008, right? And higher for 12 consecutive weeks. So, what are your thoughts on yields here? Do you think we're in the later innings here, or is this, part of a bigger picture, long-term regime shift in your opinion?
Yeah, I do. I do think that obviously the Fed's signaling that they're gonna raise rates so they get around 5% or so. So that means the 10-year is gonna eventually get around to that level too. But if you notice there on your chart, you got a really good trend line drawn there. We've been in this lower high, lower low trend for yields, kind of a deflationary trend for yields since the early 80s, right? Obviously in the 60s and 70s, we're very inflationary. But since the early 80s, it's been lower highs and lower lows for a long time. Again, according to that same intermarket relationships, in a deflationary environment, stocks and bonds tend to move in opposite directions. I think a lot of us are accustomed to when yields rise, because the Fed's raising rates or whatever, the economy's growing, the stocks rise with them. And that's been the norm. Bonds fall, stocks go up. That's, if you were to ask most traders, investors, what's the relationship between stocks and bonds, they would say stocks go up, bonds go down. That's been the norm for 40 years for the most part. That was not the norm before the early 80s. And, if we do end up breaking, as we already have broken up to new highs here, if we do end up in a situation where now we trend higher in yields because of inflationary forces, then we better start getting used to stocks, and as we have been this year, stocks and bonds moving in the same direction. Look at how many people this year have been making such a big deal about how stocks and bonds are both dropping as much as they are together. Like, we're not used to it, right? That's stocks and bonds move in opposite directions, not in the same direction, but that's what they do in an inflationary environment. And that's how we know when we're in an inflationary environment, when we start getting higher highs and higher lows in yields.
Yeah, so David, we're running out of time here, but before I let you go, I want to get your thoughts on the dollar here. Just like yields, it has just been a relentless uptrend, and there are plenty of top callers out there, and I think people genuinely want the dollar to roll over and start heading down here because that uptrend has just been wreaking havoc on stocks and other risk assets. So what is your take on the dollar here? Do you think it's close to rolling over, or do you think we're heading towards those 2002 highs around 120 before we roll over? How are you thinking about it?
Yeah, I do think it's probably going to end up peaking about the same time. The people who want the dollar to go down must not travel very much, because like right now would be like the most ideal time to travel to Europe or the UK. And this, as long as it's not in the wintertime.
Yeah.
But yeah, I do think that the dollar will peak, and I do think that a lot of people think that when the dollar falls, that's generally pretty bullish for equities. That's generally the case, right?
But how does it peak? Do you know? You know, I mean, obviously you don't know. Nobody knows. But do you think we'll kind of see this blow off top type move? I mean, usually these strong type uptrends usually end in those types of just capitulation to the upside, right?
Yeah, I think we're actually in that. I think we are parabolic right now on the dollar, moving up to the up, and it's not so much really the dollar that's as bullish or as parabolic as it is. It's more. I mean, look at that. I mean, that's a pretty parabolic move. I mean, that might be about as blow off the top of a rally outside of 2014-15. I mean, this is a pretty decent move in a very, very short amount of time. So we're going to get into this 115 to 120 area, most likely. But what's going to end up generally happening is the euro and the yen. Those are the two factors that are really pushing pound a little bit too, but mainly the euro and the yen. The fact that they're so weak is what's pushing the dollar as bullish as it is. Once they start to rally, that's going to bring the dollar back down. And again, they're not going to start to rally until their monetary policies at least match what we're doing here. The Fed's been behind the curve, but they're very much in front of the curve compared to other central banks, right? And until that curve gets shorter, that gap gets shorter, then the dollar will stay here. But that's not that's putting some pressure on stocks, but it's not the main thing putting pressure on stocks. It's those yields. It's that jump in the yields. That's the biggest factor pushing stuff. Because I mean, the dollar, as bullish as it is, you've had more. I saw someone post that we had more international flows into the U.S. markets this past week than like ever. So we're getting plenty of demand into our asset classes. It's not the dollar that's really killing things. It's mainly the yields that are killing, the higher yields that are killing everything.
That's very interesting. Yeah.
Yeah.
And we joked about the euro earlier, but I think that's a really important component in this conversation. I had John Roque on a few weeks ago, and he's been very bullish on the dollar since it broke out over a year ago. I mean, when it was still below 100. So kudos to him on being right about that. But I texted him yesterday and I said, curious to hear your thoughts on the dollar. Do you think 120 is still in the cards? Because that's been his target. And he says, yeah, that's still my target. And I said, well, I mean, it really looks parabolic here. That doesn't concern you? And his answer was, go look at the euro. Tell me what you see on the euro. And I replied, I was like, I see where you're going with this, because the euro looks like it could be in for a lot more pain. And of course, that's the biggest component of the dollar index. So
yeah, over half the index by itself. And then the yen's the second biggest, more than double the third, which is the pound. So look at the yen too. And the US dollar yen's really gone parabolic as well. The dollar is as high as against the yen as it's been in decades.
Yeah, and what is that relationship between the yen and the U.S. 10-year yield? Because I see those talked about a lot in combination.
So this relationship of stocks versus bonds, right? It's one or the other in an inflationary environment. So yields rise when stocks rise. The yen, relative to other currencies, especially the U.S. dollar, is considered, because it has for so many years had very low interest rates. It's considered a kind of the funding vehicle for a carry trade in the currency world. So in other words, it's considered a safety trade, very similar to bonds, very similar to gold, right? It would be considered a safe haven asset class in the currency world. So when yields are rising, bonds are falling, that generally puts pressure on the yen. The yen's not in demand in that environment. Obviously, right now, the yen is dropping like a rock, right, against the dollar, but yields are rising and bonds are falling. So it's not acting as a safe haven vehicle right now. It's the dollar that's been rising up along, as bonds have been falling, the yen's been falling too.
Well, David, this is all great. Thank you so much for coming on and sharing your perspective. We're going to have to do this again sometime.
Sure. Appreciate it.
All right, well, I hope you have a great weekend.
Thank you. You too.
Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week.